Welcome to the deep dive. Today we're really zeroing in on short-term stock market trading, specifically a technical analysis tool called Bollinger Bands.
That's right. We're drawing from a YouTube tutorial, hashtag stock market for beginners, hashtag Bollinger Bands trading strategy technical analysis by Pushkar Raj Thakur. It's a good one.
Yeah, it seemed really practical. And this is for you if you're looking to, get market insights fairly quickly, especially for those faster trades.
Absolutely. And for short-term stuff, technical analysis is really where it's at. It's quite different from fundamental analysis, which is more about the long-term health of a company, right?
Exactly. Technical is more about price action, patterns, indicators, just trying to read the chart itself.
Yeah, decoding those movements.
Okay, so let's unpack this. Our mission for this deep dive, just make Bollinger Bands clear. How can they potentially help you spot short-term opportunities? We want to break it down so it just, clicks.
Okay, so imagine you're looking at a stock chart. Let's say Bank Nifty, like in the video. You see the price moving, the candlesticks.
Yeah.
But without any indicators, it can be pretty tricky to see clear trends or deviations.
Yeah, it's just a lot of noise sometimes. Like, is this move significant or just random fluctuation?
Precisely, and that's where Bollinger Bands come in handy. They're an indicator designed to help us understand market deviation, how far the price is straying from its sort of normal range.
A frame of reference you said earlier. I like that. So how do we get them on the chart? Is it complicated?
Not usually, no. Most trading platforms let you add the Bollinger Bands indicator pretty easily. The default setting is usually a 20-period moving average in the middle.
Okay.
And then two bands plotted, one above and one below, based on standard deviations. Typically 2 standard deviations.
Right, standard deviations. So the core idea is that the price usually stays within these bands.
Generally, yes. Price tends to operate within that channel defined by the upper and lower bands. But the really interesting part, where the trading ideas might spark, is when the price actually moves outside those bands.
Okay, hold on. Standard deviation, just quickly. What does that actually tell us here? Why is that the measure used?
Good question. Standard deviation, it's basically a statistical measure of volatility. How spread out is the price from its average? So if the bands are wide apart...
More volatile.
Exactly. Price has been swinging more wildly. If the bands get narrow, squeezed together, it suggests lower volatility. Things have been calmer.
Got it. So pushing outside those statistical boundaries is like the price doing something unusual, potentially significant. And can you customize how they look, the colors and stuff?
Oh, yeah. Definitely. You can usually change the colors for the moving average, the upper band, the lower band, whatever makes it clearest for you to read quickly on your chart.
Okay, cool. So bands are on the chart. Now, the interesting bit you mentioned, support and resistance. How do the bands relate to that?
Well, they can sometimes act like dynamic levels of support and resistance. The upper band, if the price hits it, might suggest the market is getting a bit stretched, maybe overbought. Potential selling area, perhaps?
And the lower band, the opposite.
Right. Hitting the lower band could hint the market is oversold, potentially a buying opportunity. But, and this is really key, it's often the breakout from these bands that traders watch closely for signs of a new trend starting.
A breakout, okay. But you need to be careful about the time frame you're looking at.
Absolutely critical. A signal on a 3-minute chart might look very different or not even exist on a 15-minute chart. Especially for intraday trading or options, you really should be checking multiple time frames. Get the bigger picture.
The video showed a 1-minute chart, I think, where it broke the lower band and then, bam, shot up. But just touching or breaking a band isn't an automatic trade signal, is it?
No, definitely not. That's a common trap. You ideally want to see some kind of confirmation. For instance, if the price breaks below the lower band, you might then look for, say, a green candle to form, showing buyers might be stepping in. A potential entry trigger could then be waiting for the next candle to break above the high of that first green confirmation candle. But yeah, relying only on Bollinger Bands can be risky. It's just one piece of the puzzle.
Right. So if the bands give us a hint, a potential signal, what else can we use to, confirm it, to feel a bit more confident?
Great question. The Supertrend indicator is often used alongside Bollinger Bands for exactly that dual confirmation.
Supertrend, okay. How does that work together?
Well, the video had a really clear example. Price broke below the lower Bollinger Band, suggesting oversold or potential reversal. And right at that same point, the Supertrend indicator flipped from sell to buy.
Ah, so both tools pointing the same way at the same time?
Exactly. When you get that kind of alignment, that confluence of signals, it can give you much more conviction in a potential trade setup. It helps filter out some of the noise.
Makes total sense. avoid those false signals where maybe just one indicator is firing. So finding that agreement between tools is key.
Precisely. And you can even add more layers. Another popular one to combine is the MACD, the moving average convergence divergence.
MACD, right. Heard of that one.
So imagine this scenario, like the video showed. Price breaks the lower Bollinger Band. Check. Supertrend gives a buy signal. Check. And then around the same time, the MACD lines show a bullish crossover.
Wow, okay. Three things lining up.
Yeah, when you see that kind of triple confirmation, it can be a pretty strong indication that there might be some real upward momentum coming.
Okay, that's for buying. What about selling or taking profit on a buy? Is it just the reverse logic?
Generally, yes. If the price moves up and then crosses below the upper Bollinger Band, that could be an early signal to consider selling or taking profit on a long trade.
So you wouldn't necessarily wait for Supertrend to flip back to sell.
Not always. Sometimes just reaching the upper band or crossing back below the middle Bollinger Band after a bounce from the lower band can be a reasonable target area to book profits. It depends on your strategy, of course. Same logic applies in reverse if you shorted near the upper band.
Okay. Now, the video also warned about some common mistakes. What should people really watch out for when using Bollinger Bands?
Yeah, definitely. The biggest mistake probably is using them in isolation. Just seeing the price touch or cross a band and jumping in.
Without that confirmation we talked about.
Exactly. The video showed a clear example. Price dipped below the lower band. Looked like a buy, maybe, but no bullish crossover. It wasn't confirming. So that was likely a false signal, a trap. No trade there.
Got it. Don't fly solo with Bollinger Bands. The source also mentioned the width of the bands changing. What's the significance there?
Right. The bandwidth itself tells a story. It reflects volatility. When the bands widen out, it means volatility has been picking up bigger price swings.
And when they get narrow?
That means lower volatility, smaller price moves, things are quieter. But what's really interesting is when they get really narrow, they call that a squeeze.
A squeeze. Sounds like something's building up.
It can be. A Bollinger Band squeeze often happens before a period of increased volatility. The market's consolidating, coiling up like a spring, and it often precedes a significant price move, either up or down. It signals potential for a breakout.
Ah, okay. So a squeeze is a pattern to watch for itself. Now, something else mentioned briefly, double tops and double bottoms. How do they fit in?
Yeah, those are classic chart patterns that signal potential reversals, and they often form near the Bollinger Bands. A double top looks kind of like an M. Price hits a high level, often near the upper band, pulls back, tries again, fails near the same level, and then potentially heads lower.
Suggests the upward move is running out of steam?
Pretty much. And a double bottom is the opposite, looks like a W. Price hits a low near the lower band, bounces, comes back down to test that low again, holds, and then potentially starts moving up.
So seeing an M near the top band or a W near the bottom band adds another layer of evidence.
It certainly can, yes. It gives you more context for what might happen next. And there was a useful tip in the video for spotting these.
Oh, yeah.
Sometimes switching the chart type from candlesticks to a simple line chart can make those M and W shapes much clearer, easier to identify visually. The video actually showed a nice example of a double top on a line chart and how the price fell afterwards.
That's a neat trick. It really sounds like getting good at this, using Bollinger Bands effectively as part of a technical strategy, it takes practice.
Oh, absolutely. It's not something you master overnight. The video really stressed this. Experience and continuous learning are crucial. Understanding the concepts is step one, but applying them successfully in a live market, that takes screen time, observation, dedication.
Which is why paper trading is so often recommended, right?
Exactly. Paper trading, simulated trading is invaluable. It lets you test these strategies, like combining Bollinger Bands with Supertrend or MACD, see how they perform in real market conditions, but without risking any actual money. You learn, you refine, you build confidence.
Okay, so let's try and wrap this up. Key takeaways. Bollinger Bands are a great tool for potentially identifying overbought or oversold conditions, and breakouts can signal trading opportunities.
And it's a big, but you really shouldn't rely on them alone. Always look for that confirmation from other indicators like the Supertrend or NCD we discussed to filter signals and increase your odds.
Right, confirmation is king.
And consistent learning, watching the market, getting that hands-on practice, even simulated practice is just essential if you want to trade short-term successfully.
Definitely. So here's a final thought for you, the listener, to chew on. We talked about combining Bollinger Bands with trend and momentum indicators like Supertrend and MACD. But what about combining them with totally different types of indicators? Maybe something based on volume or rate of change. Could exploring those kinds of combinations uncover unique, perhaps even more robust trading strategies? What other signal combinations could lead to high probability trades? Something to think about as you continue your own trading journey. Thanks for joining us on the deep dive.